Now we're getting into week 4, and our learning will continue to expand, build off what we have learned in week 1, 2, and 3. Um, this week and next week is a bit advanced, some may consider a bit complex. So I would definitely recommend, uh, if you can, to attend our Zoom session this week, because I will go over the concept, obviously in person, even though I do have recordings, as you know, in most of my modules. But I think having a conversation in the Zoom session, we will do some practice problems, so this way at least you'll get a pretty good feel for it. So strong recommendation that you attend this week and even the next week and so on. But anyway, suggestion for you. Let me start out like I typically do for each week, starting with the assignments. Assignments is going to be, I have recordings for certain things. So what are we going to accomplish this week? And there is a connectivity between this week and next week, so there is a little bit of an overlap. And so you will see some of the learning a little bit also reflected in week 5 next week. So what we have been doing so far is looking through the lens of Gen Inc. that we're trying to develop a pro forma income statement which leads into cash flow. And as I have mentioned in prior videos, that one of the key objectives for a leadership, in this case, general manager of the company, is to enhance the overall cash flow of the company. And when you increase the cash flow of the company, you're increasing the value of the company. So if they want to sell Gen Inc. in the future, if they can create company to generate more cash flow, then it will be worth a lot more than it is worth today. And the question then is to say, okay, how do we increase the cash flow? One is to go into different markets or investing into more productivity and so on. So the concept for us to learn at this stage of the semester is what are some of the parameters that we want to get deeper into it. And the parameters that really tied into is that if we want to grow the value of the company, again, by making the company generate more cash flow, we may have to make some investments. And if you are going to make the investments, where are they going to come from? And I think as we learned in the prior semester sessions, weeks, that the investments can come from two places, either internal or external. Internal will be is that the company generates their own cash and keep investing. But even if they are generating their own cash and putting it in the company, that is considered as part of the equity because that's the owner's equity. So overall, the way to think about how to evaluate in terms of return an equity investor would want and a return a lender will involve is that we want to do is to be able to see is what is the expected return that our quote unquote either investors, equity holders, or lenders are expecting. And depending upon how much are we going to borrow from the lenders and how much you're going to get from the investors, we will look at it to say what is and the cost of borrowing will be different than cost the investors are expecting, because investors are taking a much bigger risk. At least the borrower has some rights to the assets if the company goes belly up and they can get some of the money back. But the investors don't. So that's where this whole notion to say, okay, what is it going to cost? So one of the concepts you will learn in quite a bit of detail through different angles, the video, the case study, quizzes, etc., is what is called the weighted average cost of capital. So I want you to watch the video and just be able to reflect on it on an individual basis. I did a strategic connectivity part 1 in the the prior sessions. Now we have connectivity part 2. So we're going to expand the knowledge from part 1 into part 2. And it is connected to the Gen So this is an augmenting video for the Gen that I've created with the case study. And now we're getting deeper into concepts like weighted average cost of capital that you're going to learn from the other video also, but also return on invested capital. What does that mean? All that is super important. It is still complex in terms of calculations, and that's why you will see me testing you, providing you, in different perspectives how to do that. So there is a summary report you're going to do on the strategic entity part 2. Again, these are all individual, as you know. There is a quiz, as you know, the quizzes are individual. That's where I will give you some data, and again, a whole bunch of information either coming from income statement or balance sheet. And I will ask you to calculate, things like weighted average cost of capital, return on invested capital, the ROIC, return on assets, and profit margin. Short quiz, 4 questions, 5 points each individually. And again, the reason I'm giving you individually, like I said, it is important that you know this material. And then there is a Gen Part D as a case study, that you will do, what you're going to be applying, weighted average cost of capital, ROIC, and so on. So as I continue in the module, the discussion thread this week, I have given 20 points. As you know, the discussion threads are typically 10 points. Why? Because this is a relatively complex topic. This is complex topic. It is an important topic. Could be a little bit heavy for some people. So I want to give the opportunity for students to be really engaged with each other. And again, the whole idea is that you will be watching videos and kind of reading the material and start to talk deeper into weighted average cost of capital, ROIC, what is the hurdle rate, and so on. And so this time around, obviously, as you're looking at it, is a 20-point discussion thread, and I think the reason is because it is that important, and obviously in some ways will require some critical thinking. As I get into, so one of the things I have done, because now we will be using some of the material from the book, and I think you all have the book, Demystified, Valuation, but in case somebody did not have it by chance, in the past semester it has happened, based on availability of the textbooks, online. I have added 3 chapters, 5, 6, and 7, which is basically what you will need. So again, it is there. If you already have the book, then this is just extra for folks that do not have the book. As I mentioned, there is a video in here for WAC, weighted average cost of capital. Some of the PowerPoint charts I used in the material I've added in here. So if you need to print and make notes. So the individual assignment, first one is to really, after you have listen to the video, and it is, depending upon if you have had experience in this arena, you may have to listen to more than once, but at least pause, rewind, etc. So what are you going to accomplish? In your own words, you're going to describe what is weighted average cost of capital. I want you to be able to reflect and think and be able to explain what it is. So for example, hypothetically, if you want an interview and somebody says, hey, what is weighted average cost of capital? You should be able to articulate it, right? How is this concept used in the financial analysis, and reflect how it applies to the Gen case? And I think that really becomes important. Approximately 1.5 page to 2 pages. I'm not that hung up on in terms of if you have more than 2 pages or a little less than 2 pages, I'm fine with it. Think of it more as a kind of looking at each concept and talking about it. So I'm pretty lenient as far as the format is concerned, because these are not like research papers or anything like that. These are kind of reflection papers, and as long as you can capture some of the important concepts, I think that should, that really is going to help you with your learning. A video on strategic connectivity part 2, it does connect from part 1, gets into part 2, gets a little complex now, may require you watching it a couple of times. Again, PowerPoint that I use associated with it. And then here, again, reflection paper, write a 2-page summary, learning from this video and how can this be applied. So, describe in your own words, key concepts covered in the video, and how do you see using it with the Gen case. And if you see some of this applying in your work, reflect on it, and and some may not. So there are a bunch of things I talk about it, but at least at minimum, you want to be able to talk about WAC again. Again, you will already have talked about WAC through the lens of the other video, but this is going to give you a slightly different perspective, and you're going to start to be able to make the connection with the Gen. Also ROIC, hurdle rate, and the fourth concept is economic value added. One of the things I will mention in the video, you will hear me talk about referring to a Coke and Pepsi case study. Last semester I had used a Coke and Pepsi. This video was recorded last year. We are not going to use Coke and Pepsi, obviously, every so often. I do change the cases, because I don't want the same material out there. But anyways, the concept is still the same. But if you hear the reference to Coke and Pepsi, don't worry about it. We have a different case. Again, that's for the week 8. But I may refer to it in the video because the video was done last year. As I continue in the module, this is where we're going to get into part D of the case study. Again, like I do typically, I'll give you an Excel file. So let me open up the Jennings part D so you can kind of see what's going on over here. And I will download it so we can make it a little bit bigger. Open it. So here we're getting into part D. We're getting into thinking about ratios, ratios like return on assets, some stuff that you learned in chapter 2 of CFIN. But the new concept, and when I say it is complex, and when it says advanced, are we getting into WACC and return on assets? So the story continues with Sarah. What is she expected to do? She's expected to go to the board meeting, and she's expected to explain some of the ratios. In here, I have provided some verbiage as a more like a learning concepts. Again, if you're looking at some of the ratios, not the ROIC and WACC, you can go look at chapter 2, in the books, but when it comes to WACC, ROIC, etc., the videos and material in the demystified book, you can find it. And so what are we going to do? Now we're trying to look to see some of the ratios. And as you recall from ratios, we're looking at it both from a balance sheet point of view, and here's the balance sheet I described to you, so this way you can get the learning, or if you already do, confirm your knowledge. What are assets? I would definitely recommend reading this to you. I think it's going to enhance your confidence in some of the concepts related to the balance sheets, equity, so on. And then we get into some of the other concepts. This is some of the new stuff. ROIC, one thing I will say, and I think I do mention it other places, the ROIC formula is provided in the business valuation book. I think on page 36. It should say ROIC. For some reason it says ROE. It's a mistypo. It should be the ROI formula is discussed earlier in the chapter. So this ROIC is on page 36, and the formula basically is you're looking at the operating income, and again, operating income. It's same as earnings before interest and taxes, EBIT. And again, it is a synonymous. You're going to find that in different textbooks. You're going to find that even at work. Operating income is, earnings before interest and taxes. You multiply that by tax rate, then you divide it by debt and total equity. Debt, again, you'll hear a lot in the video that, a couple of the videos you're going to watch. It is interest-bearing debt, okay? Again, and I'm not going to cover this obviously in this overview video, but you just kind of go through and see what's going on. And again, your submission, being a quantitative class, obviously I'm looking for quantitative thinking, quantitative analysis. So you're going to conduct the analysis as provided, and again, like a one-page summary of your learning on ROIC and WACC as it relates to the concepts. And again, my whole idea is not to also teach you and have you become more comfortable with the concepts of formulas, but again, be able, what do you do as a business person in the real world, right? That's really what you want to do. So starting with the information, you're gonna relearn. You already know how to normalize it, or same thing as quote unquote, common sizing it. You will do that. And here, the balance sheet provided, and then I've also kind of referred to some of the formulas here, but you can find the formulas in the book. Your job is to calculate these things. What is ROIC? What is, cost of debt, et cetera, and, just kind of referring to this video that I already talked about, it's already in the module. Now, in order to help you, I like to call it the replicate analysis. I think you saw that in the other case studies, like in Jennings part 3. So here I've given you a similar problem with the answers, obviously without the formulas. So here you got your income statement, you got your balance sheet, the numbers are slightly different, and I've given you the answers. And I think if you can calculate these answers, then obviously you know how to do it. So kind of keep that in mind, as you're doing it, practice. It's in the appendix, and I think it's going to help you do that. So if I continue now to in the module, there is a quiz, short quiz, again individual. I want to make sure everybody knows how to do some of the calculations. So there are 4 questions. Now there is going to be more data than you need, and the reason it is important is because if somebody gives us a problem, obviously we'll have to go find information. So there's more information than you need in each of the questions, and I'll tell you what I mean by that in a second. But what are we trying to accomplish, right? The learning is to identify what formula you're going to use, find the formulas from this module or prior modules of the textbook, identify what data is needed to solve it and solve it. There are 4 questions, one related to profit margin, one related to return on equity, one related to return on invested capital, ROIC, and one related to weighted average cost of capital. When I say a lot of information available, what do I mean by that? Let me just show you, what do I mean by that. So if I look at a question, it'll give you this information. The first one is calculate the profit margin. You look at the data, and I'm going to give you an example. If you're calculating return on assets, how would you do it? You would take net income divided by total assets. So that's what you want to do. Now, ROIC and WACC formulas are a little complicated, so be aware of it. Return on assets and profit margins or return on equity are much easier to do that. So now if I just leave it the way it is and continue from there. Now, this is what I mean by a little bit of connectivity with the next chapter. That you're going to hear me talk about in one of the videos, NPV, IRR. So now I've added some videos to kind of set the stage for what does NPV and IRR mean. Very, very important subjects. You'll really need to know this, especially going forward in your classes. So what I want to do is to make sure that you are comfortable, so you are not being tested, quote unquote, directly at this stage for this particular week, but you will be in the next week. But it's there for you to kind of keep in mind and know what it is, because NPV IRR is super important in terms of mastering it as an MBA student. So again, some information and so on. So that's really is the module. I will go back home. That's the module, and I hope this is helpful. And again, strongly recommend that you attend the Zoom meeting class this week. We will do some practice. You will practice yourself, and I think that's going to really help you. So have a great week, and we'll continue the journey as far as the learning is concerned for finance in our MBA.